All right, what's up, premium members? Um, this is the long-awaited video of the fake flip zone model. Um, going to be hard to follow if you haven't watched all the other videos yet of the core content material. So if you haven't, please go and watch those. That includes market structure, candlestick structure, advanced market structure, and candlestick structure, the Mark II model, non-structural highs and lows, or low, also known as the low tapbacks and stuff like that. Um, so please watch that, and then we're gonna get into a couple examples. I'm gonna go ahead and find them and move my cat, and then we'll get started. Oh, there he goes. Okay, let's find some examples real quick. Oh, and also, obviously, you're gonna need to watch the actual fake flip zone videos as well, the core content videos. Or maybe there's only one. Yeah, but you need to watch that. And yes, I do need a haircut. This is horrible. You need to watch that because that's literally what the model is based around. So, really, I know I've said this like multiple times, probably getting sick of hearing it if you listen, but if you haven't been listening and you're watching this video and you have not watched literally every other video in the core content, please just quit this video, go watch those, and then come back. It'll still be here. Like, you're not going to help yourself at all. Even if you think, oh, I already know market structure going into this, like I studied this guy or that guy, or I was in Charters Anonymous, whatever. Like, you have to watch all of the videos before you watch this. Everything prior to this. So, fake flip zones again. Yeah, market structure, candlestick structure, advanced market structure, candlestick, and the Mark II, and the high tap back, low tap back, all that. Please just watch it and then come back here. So first off, I want to start by actually doing the diagrams. That was my bad on saying we're looking for examples immediately. We are going to do some examples, but first we're going to draw it out on how I would look for the setup just from a technical analysis standpoint, first and foremost, before taking a trade with this model. So this is the you know the trading entry model. This is not mechanical. This is like, I don't know how else to say it. This is not mechanical. If you just look for this to happen, and every single time that it happens, you try to take the trade and hold it to infinity and beyond, you're probably I don't think you're going to be profitable because you have to use discretion. There has to be other confluences coupled with it. So we're going to get into that later in this video on what those coupled confluences will be as well. So to start with, you all know the fake flip zone is let's say a fake flip down would be where you are trending down and you flip up, and then after that flip up, you go and flip down below the flip up. So this is a flip up, this is a flip down, right? But the entire thing is the fake flip zone to the downside. When you have that flip up, not once you get the flip down here, but once that flip down sends price to go close below the flip up, that makes this entire thing a fake flip zone. So in general, to start with, at a basic rule of thumb for this trading model specifically, whenever we have, let's say we're looking for an opportunity for longs and trying to catch the like one time frame up or maybe even two for time frames up on a flip up, then we would look for something like a 1 minute swing. So let's say that this is a 1 minute swing, and then we would look and see whether or not the 1 minute had flipped up here or not. Doesn't really play a factor in the actual model. So We're not going to talk about whether it flipped up right now yet. That's going to be case by case basis. But let's say that right here we have a 1 minute swing down, structural swing between this high, this external low and this protected high. What we would do is, if we have a reason to believe, actually, hang on, let me not get into the explanations. Let's just talk about the model. So first of all, you're going to mark out your zone, right? So that you have your structure on your screen. You need to be having your structure on your screen. And then after that, we're going to be marking out the 60%. So I have this set to this fib set to 40 and to 60. I have it set to 40 and to 60 because no matter how I press it on there, it's always going to have the 60. So if it's, if I was to draw it backwards for some reason, it's always going to have the right level on there, so I don't have to finagle with the numbers every time that I use the fib level, right? So essentially we're always 60% into the swing at this higher, or on the downside at the lower line, right? So now we're going to switch the color here. So let's go and switch the color to symbolize that we have switched to the 5 second, okay? So we're watching the 5 second now. And the 5 second has made a flip up, right? That'll typically look like a valid external low pullback on the 1 minute. So the 5 second has made a flip up, and now it is trending up, okay? And as it comes up, it can touch the 40 or something around there, and it can flip down, or it can touch the 50 and it can flip down, right? But those are all just confluences if you have a short bias for an opportunity to be going short with the market flipping back down and the 1 minute being bearish in this instance, right? We would be trying to look for an opportunity there. And same thing, when it touches the 60 as well. And it can flip down, it can flip up, right? It can flip down here and flip up here and then flip back down and go lower, whatever. Okay. But inside of this model specifically, I'm like so nervous to teach this because I've had so much stuff taken out of context in my time doing the previous mentorship and stuff. Like, I literally have a horrible knot in my stomach because this is like a genuine with great power, great responsibility kind of scenario. I don't want people to just like butcher this and uh um anyways, again, this is the 5 seconds, so we're coming up into here, right? Once we hit this 60%, okay, once we hit the 60%, if price flips down, then that is for me a place where if I have there's two ways that I play this. One, if I have confluences telling me that there's potential for a continuation lower and that we haven't fully made our draw yet, but we have made some draws and so we could go up from here. This is a great hedge opportunity for me personally. That's how I like to use it in those scenarios, is that if I think that there's a possibility of price going in both directions and my bias is to play either side because I can see both sides of the market in that moment, which sometimes is my bias, then what I'll do is I'll go ahead and take my short, and if it becomes invalidated, then I don't just exit, I flip to longs. In this instance, we're just going to talk about the fact, let's just say that we have really made a draw. Like, let's say that the 15-minute had just made a fake flip zone, it made a Mark II, and it stayed bullish. And so this was the Mark II we just swept out right here. And we're freaking going. And we think that we're going to flip up on the 1 minute. The 5 second is flipped up. We hit the 60, we flipped down, right? Then in that instance, it's not really a hedge position because I'm not necessarily looking for the shorts. I'm not going to be taking every single, mechanically just trying to trade a flip out of every freaking 1 minute zone. If you do that, you're not going to be profitable. Right? So and that just made me realize I need to actually, after this, record the basic market structure format for flips inside of zones, trades, and I'm actually going to post this one before this. So if you haven't seen that one, stop this now, go watch that one. I didn't mention that at the beginning of this video, but that video does actually have to come first before this. So let's get into it. If we believe that price is going to flip back above this, okay, then or we would wait for that confirmation and then use that confirmation to take us through the flip, and then that would translate to holding that trade into whatever area that we're targeting from the higher time frames perspective, right? So if this trade is all in all coming from the 15-minute and we're trying to target a 1-minute flip, that would mean that we're hoping that that 1-minute flip can then lead to getting us over a 15-minute external high and making a 15-minute swing. So maybe our 15-minute external high is way up here, right? And in this scenario, that 15-minute external high also would look like a big flip down on the 1 minute, right? That we're going to have to get through. So we'll have a similar scenario come up there, up higher, but for now we're talking about getting in. So when price goes back above this flip, if it is a truly structural 5-second flip in this instance, and you have the structure correct, the 1 minute has a swing here. We're up to the 60% of it. We flip down and we have a reason to believe we can go higher. Then the entry model that I'm using currently is once we go up above this line right here, not once we go up above the 60% again, but once we flip back up and make a fake flip zone on the 5-second, right? Make a fake flip zone on the 5-second. That is the trigger for me to go long. And sometimes like let's say it closes out and then immediately rips down, and then we might be looking at some sort of like double valid pullback, Swedish closure, invisible zone sends us back down a little bit lower to the original flip. I might wait for a retrace to like this structural swing or the flip or whatever. But in general, my stop loss now is going to be below what would be the bottom of that flip of the one time frame up. So this is the 1 minute. Then wherever I'm getting in, whether I'm getting in here and just hoping it just goes straight up, or whether I'm putting on small size and adding when it comes down, or whether I'm just setting a limit and saying, hey, I think that it's going to come down, and if it doesn't, I don't want to participate in it. Whatever it is, right? That's going to depend on your target. Personally, for me, for risk reward ratio, it's going to depend on the target. So if my target is right here, okay, then I need price to retrace, or I need price to establish something inside of here that I can bet on holding. And if the target's way up here, then it's a lot easier for me to justify going ahead and just hopping in, because my risk versus reward can be positive. So the model is essentially you're waiting for the 60%, you're waiting for its lower of the swing, the structural swings or flips, whatever it is. It works for fake flip zones. It works for flip zones. It works for swings. It's not really. This is a mechanical tool to use in a non-mechanical way, right? So you're using this. You have to look at this objectively and mechanically, but you cannot choose where you use it objectively and mechanically. You have to be the one to decide. You're the professional. This is why you're going to get paid to do this, because you have to look and decide, where am I going to use this mechanical entry model and where am I not going to? And that's why I say this is not mechanical, because the structure of this itself, yes, there's rules to it that you can code, but where you execute is a totally different story, and we're going to look at some examples now of where you can execute it. But this is essentially the model right here. So let me just put that on there, and then wherever this would be. And this isn't always the case, by the way. So putting this here and the stop loss all the way down here, there are possibilities again where you can establish like a better stop loss. For instance, if price was to then come down and flip back down and then start to trail up and give you double lows or something, or get, push right back up into that aggressively, you could then take an entry and put your stop below, wherever it had gone back down to. So in this instance, let's say it's gone back down here and then comes back up, you could potentially do something like this, right? Because then if we have a fake flip zone, which is essentially a 1 minute swing on invisible market structure, and then we go under it and then back up above it with closure, that would insinuate that if we are to flip down below this, that this is no longer valid to hold anyways, because the market pressure that was able to get us through this incredibly strong low is probably also going to be strong enough to get us all the way through this bottom. But case by case basis, the mechanical model in and of itself is just this right here. Okay, so let's go get into some real examples now. Okay, I have a really, really good example here. This is actually the one that I was calling out to the premium members in real time. I said someone identified the 1 minute flip down and sent a photo of it in this chat, and people were sending photos of exactly this. So I was able to find where it was based on the time we were talking about it. So let's go ahead and get into what happened here, because this is, God, a beautiful example, and this is going to show you the mechanical side of it, and it's going to show you the intuition side of it, or the experience side of it, the stacking confluences side of it. So not just mechanical, but also some discretion, and it's going to be beautiful. So let's go ahead and start by analyzing the 15 minute. First and foremost, we have a 15-minute swing right here. Okay, 15-minute swing right here. And this is a swing because you guys already know market structure. I'm not going to get into that. It's my bad. But you know why it's a swing. So even from a higher time frame perspective, actually, let's go a little bit higher and let's see if we made any draws on liquidity here. So right off the rip, I'm seeing that we have a daily swing right here, right? So we've gone into the discount of this daily swing. This is also a 2 hour fake flip zone. Obviously, you guys already know that if you're watching this video. So we flip down, we flip up. That makes a daily swing. From the 2 hour flip down, flip up makes a daily swing. So we've made a draw here. Okay, made a draw here, and not only have we made a draw here, but at this point in when we're looking to take this trade, we've also closed an IFVG on the 2 hour, which is really, really strong, especially after going into the discount of a daily swing down, right? Or a daily swing up. So let's go back to the 15. Let's identify the structure here again. So currently what we're looking for is we're looking for a 15-minute flip up. And because we're looking for a 15-minute flip up, we're also looking for these non-structural highs to get taken out. These are non-structural highs because they are not valid according to invisible market structure. So first of all, let's just look at the 2 hour again. For one, definitely, obviously not a structural high on the 2 hour. And the 2 hour is making the IFVG. We're in a daily discount of the swing. I mean, we're talking about some very, very, bullish, some very high bullish potential after a day of a lot of downside. Okay. We have the Mark II way up here. We have non-structural highs up here. If you go to the 1 minute, we'll discuss real quick why this is not a structural high on the 1 minute or the 15. Well, on the 1 minute, it is a structural high on the 1 minute. Why it's not a structural swing on the 15? That is because, first of all, on the 1 minute, we make a swing here. And as you guys know from market structure videos I've made already that you should have watched by now, the only thing that can validate, according to invisible market structure, the only thing that would validate this as a 15-minute swing from the 1 minute chart, right? One minute chart up here. The only thing that could validate this as a 15-minute swing is going to be if the 1 minute flips up and then flips down. Okay, so that's not we're not always looking at that, but in instances like this, right, we're looking at it like this. And that's why I took the trades that I did. So let's go over here and see, did the 1 minute flip up? As a matter of fact, it did not. It couldn't flip up. It flipped. It tried to. It wicked out a few times and it didn't. So because of that, we're disregarding this as as far as invisible market structure goes. So even though it looks like on the 15 we have a swing here that we could potentially flip up into and then flip back down. Even if it was a swing to begin with, even if it was a swing, um, in that instance, a flip is typically weighted higher, stronger in our opinion in general, especially after making a draw like this and doing this to our IFBG. We're already, even if this is a swing, we're looking to get through it, but just the fact that like the invisible market structure tells us that it's not is even better. Because according to visible market structure, you're looking at this close down, and then you look at this candle go close below it a little bit more, right? So now we're looking for a closure above this instead of above this. And then price closes above it, validating this as a low. And so according to visible market structure, this is a swing. So that's why invisible market structure is really important to watch and understand, because the 1 minute not actually successfully having closed up above this means it did not flip up, so it did not flip back down, it did not make a 1 minute fake flip zone. So you to the naked eye, this looks like a 15-minute swing, but we know on a deeper level that the market will not consider it as a 15-minute structural swing. It'll just go straight through it with no respect. If we flip up on the 15. If we don't flip up on the 15, we don't know what's going to happen, right? So we've got to figure out, are we going to flip up on the 15? And if we do, we have a very high risk reward ratio setup coming in our direction here. So let's get into what happened down here on the 1 minute. We went and poked outside of this 15-minute high. Remember, this is the 15-minute swing. This is a 1 minute flip up and then flip down. Okay. So this is a big 15-minute swing here. Well, it's not very big for the 15-minute, but on the 1 minute, it's big. Right. We're just going to go ahead and label this 15-minute protected high. So we're seeing that we have swept out the 15-minute protected high. It looks like it closed on 1 minute, but on the 15 it didn't, right? It's just a wick on the 15. So being that it's a wick and then it flipped down, in this instance, if you believed and had reason, if you had reason to believe that you could continue going down because you believe that this swing here is actually, truly structural on the 15, right? If you think this is a structural 15-minute swing, then what we could have just done is we could have just done some sort of low or high tap back sort of thing where we go over this and then we just wick out the liquidity, do a stop rate and continue dumping. But I didn't believe that that's what was happening because I don't believe that this is actually structural, and because I don't believe that I don't believe that this flip down on the 1 minute is going to hold. So because I'm skeptical of it holding, I'm zooming in and looking. That's why I was saying here. This is what happened. One sec. I said, someone identify the 1 minute flip down and send photo of it in this chat. Send a photo of it in this chat, right? And then they all showed me that, see, this is the swing up. So this has been the flip down right here. This is the flip down right here, right? So they can all identify, see, he has the low marked out. They all know structure, right? And then what we saw was a flip below structure. So let's go ahead and mark out our structure real quick. We got the 1 minute, we got a high, a low, high. I'm going to switch this back to blue in a second here. A high and then a low. And then once we go up and close above this, then we're going to establish our next high, right? Once we close below it. And then we have a lower low because we went and closed below this. So that makes this a flip down on the 1 minute. We have swept a structural high on the 15 and flipped down. that is going to get 90% or like this gonna be that gets so many traders. If you're a structured trader, you probably shorted this and lost because you saw it and you thought, oh, it's a double top or whatever, right? And you're missing this piece, and that is that once we have this flip established, we're going to mark it out, right? If we can go close back above this flip, that makes it so likely that the 15-minute isn't just doing a double wick, but that, especially because all the bullish confluences are aligning, we believe that it wants to close above there, but we need confirmation that it's going to before we get in and decide to hold this for a big long trade, right? So it makes a flip down, and then we mark out this 60% of the zone, okay? So let's get rid of the drawing. I'm gonna make this blue real quick and then delete it so I can have it blue for next time. Let's get rid of this drawing, okay? Let's get rid of this. Let's get rid of everything that could distract us and just focus on the model now. So right here, we have a flip down, right? We have entered into the premium of the flip down. We have entered into the 60%, right, which is the mechanical side of this model. And it looks like we've actually made a structural pullback, which may be a 5-second flip down. Let's go and see if it is a 5-second flip down. Okay. All the way over here. It's going to be, I hope we can actually get to it. Now that I think about it. Uh-oh. You gotta be kidding me. No, please. Are you really not gonna let me get to the... Oh, this is that gap, isn't it? No way. It's not gonna let us get there on the 5-second. There's gotta be a way. Hang on one sec. Okay, we got bailed out by past me. So unfortunately, we can't go back this far on the 5-second in this instance. But I am going to pull up the picture that I sent of the 5-second, which happened right here. So super lucky. Let's take a look here. This was the thing I sent. I said, now look at the 5-second. I said that in all caps, right? So let's gauge the price here. So it looks like the top of this is around 265, and if we look around here, we can see the top of this was close to that 265 mark. So we're definitely talking about this, or this is the photo, okay? Let me get rid of this. So this photo, this box that I have drawn from is from about 245 to about 263. So if my calculations are correct, let's say 235, right? Somewhere in here. Let me try to figure this out for sure. It's a little lower than 235, like 234-ish. So 230. Let's just call it this one. This was, and maybe it's not exactly this one. Maybe there was a wick that happened in here that like isn't showing up. So we call it like right here. But this was a flip down on the 5-second, okay? So get rid of that picture. This is the 1-minute flip down. This is the 5-second flip down. This, okay? Look, so you can see it more clearly. These red lines are this is the 60% right here, okay? Let me try to get rid of the other one. Let's just do, that's why I have the 40 and the 60, see? So get rid of this. This is the 60% of this flip down, okay? So we have flipped down on the 5-second, and we are intending to flip back up above that. We're above the 60%. And if that happens, we believe we're going to flip back above this zone. Now, if we flip back above this zone, that makes this entire thing a 1 minute fake flip zone. If it makes it a 1 minute fake flip zone, if you've studied market structure, if you studied invisible market structure, the video, multiple times, and you'll remember that the 1 minute flip down and then flip up is similarly uh, like a 15-minute swing. Okay. Not as strong as 15-minute flip, but a 15-minute swing. And if 15-minute swing is happening up at the top of the 15-minute swing here, right? If this 15-minute swing is happening up the top of this 15-minute swing here, then it's likely that we're swinging through this, which means it's likely that we're flipping up. We've got the 2 hour IFBG. We've got the non-structural highs and the Mark II as targets above. We've got we're in the discount of the daily swing to the left. I mean, everything is aligning for there to be a trade here, and it's so funny that it all hinges on this right here. It all hinges on whether we go above this. And notice that once we do go above it, there's no turning back. Now, that's not always the instance, but in this instance, it was totally my expectation. It was totally my expectation that there would be no turning back. But I do know that there's no promise of that, right? So what we're doing is we're looking at this from two different perspectives. One, we're looking at it from the perspective of this is going to serve as a 15-minute, because in this instance, this is a flip down and then up on the 1 minute, right? We're thinking that we can put our stop loss below this instead of below the entire 15-minute low. If this was just a 1 minute swing rather than a 1 minute flip, then it would be a little bit different. We would be first starting out with our stop here and then waiting for a fake flip zone to finish printing, and then this was an instant. This was an anticipation of an instant fake flip zone on the 1 minute. So let's walk through the whole process one more time. What we did was we identify this high of the 15-minute. This is where the 15-minute would flip up. We identify structure on the 1 minute, and we find that this is a flip down on the 1 minute. We mark out our flip down on the 1 minute. We're looking for an excuse to go long with a safety net, right? With there being confluences, with there being a safety net. Go ahead and mark out our 60% of this swing, right? And I'm going to go ahead and get rid of the swing. You guys know this is the 60% of this swing here. Or actually, I can just put it here to where it's not like in the way of the stuff. So this is extending from this zone here. This is the 60%. Then inside of here, right? Inside of here, we have a flip down, okay, on the 5 second above the 60%. And then we have the flip back up above it. And then once it flips up above it, it doesn't even come down below this fake flip zone. So it doesn't flip down on invisible market structure on the 1 minute. It doesn't flip down on the 15 or anything. It just goes. So what I did was, let me look. I actually kind of got in on a couple a little preemptively because when we swept this out and then had a 5 second flip up in here, that was already getting me in. And then when we flipped down, I was like, okay, I'm protected. I'm just going to stop myself out at break even if it comes back down here for me. And once we flip back up, I instantly added. I kept my stop loss where it was because I believe this was going to be a fake flip zone on the 1 minute, equivalent to a 15-minute structural low. And I just let the price do its thing. And then I think my target was like 500, and I took profit a little bit before it on my final contract. And that's because I was being conservative, right? So you can hold it to all the way through, nothing wrong with that. I was being conservative because if the market somehow, if I haven't actually outsmarted the market, which sometimes I don't outsmart the market, then this is still a swing, and I don't want to get caught getting into the premium of this swing, and being greedy. Or discount of this swing, premium of this swing. Yeah, I don't want to get caught getting into the premium of this swing and being greedy and it coming back against me and having to secure less profits. So I just took it. I mean, made good money on it. Honestly, it was like a great trade. So yeah, we have, as you can see, a bullish bias. And that helps make the decision to get into this trade in the first place. But this is the model for the confirmation right there from a mechanical standpoint. Let me go find another example real quick. All right, I found another Primo example. This is one that we actually have talked about in the group as well. Kind of saw this one in real time, and well, actually, it was over the middle of the night, but we saw it on the day that it happened. Um, and uh, I think we're able to use it. I don't know if I did a trade recap video on this one. I don't know if I took it or not, but I know that we talked about it. I've done so many of those videos, it gets mixed up, but this is a great freaking example. So let's talk about what happened here. First of all, we have clearly bullish market structure, right? Because if you look at the bottom left of your screen, uh, it is lower than where price is on the top right of your screen, which means price is going up. So yeah, anyways, we have bullish behavior. We've got a 2 hour swing here. I'm looking at the 15-minute chart, but I know this is a 2 hour swing because the 15-minute flips down and then up. And then again, we actually have another 2 hour swing right here because the 15-minute flips down and up. But we are getting that 2 hour swing to occur right here, which is the beautiful part. We're catching the 2 hour swing before the 2 hour swing happens. And instead of trying to, trade the 50% of it right here and get cooked, um, we are able to see more clearly using a visible market structure and this fake flip zone model. So let's get into it. We have a low way down here. We have a high. We have our low again, and then we have a high right here. Now you can't see it unless you zoom in, but let's go take a look at it. So first of all, draw this high. It's got to be a closure above. So boom, we get a closure above. And then look, you guys know market structure and candlestick structure, external high, structural protected low, right? So here we are, high, low, high, lower low, right? We're going to put the lower low, let's draw it out all the way down here. So this is on a slightly broader scale. So instead of the 5 second giving us the fake flip confirmation, which it does, you're going to see, and it's freaking crazy. Well, you won't see the 5 second because it's too far back, but I am going to show you where, I'm going to draw it out for you. But this is the 1 minute fake flip zone at the 60% of the 60% of the 15-minute flip down. And if we catch this move, then we know that the 15-minute is going to flip back up. If the 15-minute flips back up, that is a 2 hour swing up. It's a 15-minute fake flip zone. And on these 2 hour swings up, yeah, we really like to see extension out of them. In my personal backtest study, and don't use this as a mechanical statistic for fuck's sake. I feel like I have to keep saying that. I'm like traumatized from the people that I mentored or at the beginning of this year. But typically in zones like this, when I find the entry confirmations, I see that, there's like, there is a measure of this entire zone or parts inside of it where, like, if you were to use standard deviation or things like that, you can really a lot of times lock in like a 3R kind of a target based on some sort of spread and a manipulation inside of the zones, right? And so what I'm saying there is we believe that we're not just going to get in here with a stop loss here, right? We believe we're not just going to get in on this and put our stop loss below this and just target the top. Though that's not a bad trade because it's a 1.5R, we believe that the extension past this on fake flip zones, on the 15-minute being a flip down and then flip right back up, that we're going to have an extension that will, punch higher because once we take this top out, then it's the market is back to bullish and there's going to be a big push up that leaves a bunch of people behind, and then it comes back down and does whatever it wants to after that, right? So there's a lot on the table here because we believe we're catching a 2 hour swing before the 2 hour swing is actually finished occurring. And another way to put that is basically that we would be able to look and visualize using the 2 hour that we believe that the 2 hour is going to close, so we can at least, if this is going to flip up above this fake flip zone, then we can at least anticipate that the 2 hour will hold and close, which means at the minimum In this instance, we could hold it until this 2 hour closes right here and then wait and see what it does after that, right? Because we believe that the 2 hour is going to make a swing. So for it to make a swing, it has to close above this. A safe bet is just to hold the trade until it closes, right? So look back at the 15. Let's actually go to the 1 minute instead. So it's, I do not know where it is. It's right here. Yep, right here. This is so beautiful, guys. I already went ahead and drew the 60% of the 1 minute swing out as well. So this is the 60% of the 15-minute flip zone to the downside. This is a flip down on the 1 minute. You guys know candlestick structure. You're smart enough to figure this out. Look at the timestamps and everything. Here's our highest bodied bullish candle, and then we put in another highest bodied bullish candle, and we put in another highest bodied bullish candle, and we clearly close below those, and then we clearly go close above them. That makes this right here a swing. That makes this right here a flip down. Okay, so we have a flip down. Here is the 50%. Here is the 60% of that flip down. So first of all, off rip, if you want to completely disregard the 5 second, which I know like childish, if you're watching this, and I know you will be watching it, you talk about not really using the 5 second. This is an example for you. Us going and closing up above this right here would insinuate that the invisible market structure is calling for this to be a 15-minute protected low, a 15-minute swing right here, and looking for price to carry us through the top and continue on its merry way on the 2 hour, giving closure way up here, right? Um, but you can even get more into the nitty gritty right here and look and see that there's a 5 second flip down. You guys just, I don't know how many, I don't have a picture. I looked already. There is a flip down here. So it's, I think there is a flip down here on the 5 second. At the very least, there's something that looks like a flip down, but then look, it just goes right above it. Now it does go wick out this bottom, which is why, if we're basing this for a 2 hour trade, we're not going to be using a stop loss on a 5 second fake flip zone. It's more like, the anticipated 1 minute fake flip zone, because that would be a 15-minute low, right? According to invisible market structure. So let's watch what happens. It flips down. We put let's get rid of this first. Okay. This is the 15-minute, 60% of the flip down. We flip down on the 1 minute. We go and flip back above it on the 1 minute, right? With closure above this. And in this instance, we're looking for price to not only go out of here, but we're looking for price to go out and close on the 2 hour up out of here, right? Go back to the 2 hour real quick and let's see that closure happening right there. Okay, 100 points. Pretty easy model right there. Now let's zoom in and get into the finer details and find what's going on the 1 minute that could have gotten you in even sooner, right? Because it's not a bad idea to refine as long as we're not refining to the point where we're throwing the baby out with the bathwater. So in this instance, here's our flip down on the 1 minute. We're going to go ahead and also measure out the 60% of it right there. Okay. We flip down on the 5 second. We flip back up on the 5 second above that, above the 60% of it, right? 60%, flip down, flip back up above it. That right there is confirmation to me. That is confirmation that we are going to go close above this. If we're going to go close above this, that's confirmation that we are going to go close above this. If we're going to go close above this, then I'm going to wait for the 2 hour to go close above it and then take my profits and maybe leave a runner, maybe not, right? This is a perfect example. And you guys are going to see this like so much, especially if you're a 5 second trader. You're going to see this a lot. And remember, it's not just on these models that are these massive fractal models. And really, I didn't have to work very hard to cherry pick these. I mean, these are just examples that we've literally talked about and reviewed already. But that is how I would trade those. I would look for the 5 second to make that flip up to show me that it's going to fake flip zone the 1 minute in the 60% of the 15 minute zone right here. The 15 minutes flip down. Um, or just wait for the 1 minute, take that entry and hold it and let it do big things for me. Um, yeah, if you guys have questions about this, like please ask away. And I know that this is gonna seem complicated, but really it's just about like being imagine that you are um imagine that you're like a chef in a kitchen and you're trying to make a really nice meal. All the times that you or even just cooking at home, like let's say, you're making it for your significant other or your family, if you're making a Christmas dinner, right, or something like that, it's not just a one pan deal, right? You're not just saying, hey, I'm going to make chicken, and it's that simple. You take a chicken and you just throw it in the fucking oven. And I mean, it can be, but really, you're taking the chicken and you're having all these components to what you're doing. You're brining the chicken, you're making a seasoning rub for the chicken, you're making side dishes for it, right? So all of these things coming together um, make the meal whole, make the meal complete and satisfying and um, a special thing. But when you're just saying, when you're just saying, well, the 1 minute flipped up, let me long, then all you're doing is just handing somebody a chicken that you took out of the pack and threw in the oven and then took it out when it was smoking, right? This is the art of profitable trading. Your job is to combine all these things together to find trades that are just so convincing. I mean, you're seeing this, you're like, God, this is perfect, but I've seen all these examples and it seems like they're always perfect. Like, no, this in real time, as I painted out for you guys, this is how it works. This is how the market decides what it's going to do. And it decides in this very small window. And it shows us what it's decided in a very small window. It decides before. We're not, it's not like randomness is in control there all the time, right? Now, the market, it seems like it's really random a lot of times. But in those instances, I don't think that it was random. I think it's predestined in a lot of ways. But we can see immediately by zooming into the 1 minute, the 5 second, what's going to happen on the freaking 2 hour. I mean, we're talking about a 5 second. And so you see how these guys talk about sniper entries, this and that. The real long term snipers on NQ, they don't survive unless their snipes are coming from confirmations. Um, if you're trying to come up with a model like the Mark II and you're using it mechanically where you're just drawing the line and taking entries when it gets touched, you're not going to survive long term because it doesn't work out that way where it just, anytime that there's a Mark II, anytime that there's a flip and then a touch, like imagine if you had tried to take the Mark II here, right? Imagine if you had tried to take the Mark II here. So what happens? Um, we have a flip down on the 15. We have a tap back. This tap back sends price to go below here. So we would anticipate that once it touches this, we could see potentially price go and trade and continue down through this low. If you shorted this right here, right? If you shorted this right here and you put your stop loss up here, you're cooked. I mean, like you just lost the freaking account and the house with it. No, excuse me. You just lost the freaking house with the account, right? You lost the house account, the house, and the account all at the same time. And we're not trading touches. That's not what a real sniper does. That's not what a real trader does. We're gonna be doing hard work and putting diligence and experience, years of experience, or unlimited hours of studying, uncountable hours of studying, commitment to understanding all the confluences of the market. Our job is to put them together all as one and find in that moment what's going to happen next from the lower time frame to the higher time frame. Um, so yeah, again, questions, message them in the premium chat so that everyone can benefit from them, from you asking them and me answering them. Um, and enjoy the holidays. Please don't be trying to trade the hell out of the market in like the little crossover days between Christmas and New Year's and stuff. Like I've seen in back testing, like what let me put it this way: when I'm on FX Replay and I am back testing, which a lot of you guys know, I've back tested starting from 2012, and sometimes even further back than that for experimental reasons, but starting from 2012 all the way through present day, two times over. And I skip this week every time. I just next day open, next day open, next day open, next day open until I get to like January 3rd or 4th or something like that. If it's not like a no news Monday, right? So just take your time to backtest and practice and learn and rewatch this video a bunch of times. It's a long video, but it's to cover trading entry models. So yeah, if I didn't give enough clarity, let me put it again in this way. How I would enter on this is to take a long after that 5 second. It tells me that the 1 minute's going to flip up. If I'm not using the 5 second, I'm waiting for that 1 minute to give that confirmation. I'm putting my stop below there. I'm putting my first target somewhere above this. I'm putting my second target once the 2 hour closes, and I'm putting my third target, as a runner with my stop loss trailing. Okay. And then on the other example, how I traded it in real time, which you guys saw, was, let me go look and see. I actually have a picture of it somewhere. This is a 235 point long. That's so lit. Because that was my first partial right there. But how did I trade this? Yeah, I just went ahead and put my stop underneath the low. Like I said, this is the 1 minute chart. So let's go to the 1 minute here. My stop was underneath this. Actually, my stop was underneath this just in case that it wanted to double low or like equal wick this or something, but hold this structural low. So it would have cost me an additional 3.5 points. But that's how I traded it. It looks like my entry was 250 on average. Like I said, I got a little size down here after the flip up, and then I added on more. Once we did this confirmation, so that put my average at 250. But in real time, you would see me entering off of. If I hadn't gotten in early, in real time, you would have seen me entering off of this right here at around 265 with a stop below here and a target at 500 or higher, the 50% or higher of the truly non-structural swing right here. Structural visibly, non-structural invisibly. That is all. Yeah, I hope this helps. See you later.